Is ICT's smart money concept just retail trading repackaged? Or is it a revolutionary way of understanding how markets really work? In this video, we'll compare the similarities and differences between retail trading strategies and ICT concepts. We'll explore concepts like order blocks versus supply and demand, liquidity pools versus double tops, and optimal trade entries versus Fibonacci retracements. And dive into the big question: are ICT concepts plagiarized or a legitimate evolution? So, let's talk about order blocks and supply and demand zones. Look, if you've been trading for more than 5 minutes, you've probably heard people screaming about these zones like they're the holy grail of trading. And honestly, they're not wrong. Both order blocks and supply and demand zones aim to highlight areas on the chart where price is likely to do something interesting: reverse, consolidate, or break out. But here's the thing: supply and demand zones are like that friend who gives you vague advice. They're broad areas where price might react because there was strong rejection in the past, like a rally-based drop. It's useful, but sometimes it feels like throwing spaghetti at the wall to see what sticks. Now, ICT's order blocks? They're a bit bougie, let's be real. Instead of a big vague zone, ICT zooms in and says, "See that one candle? Yeah, that's where the institutions made their move." Order blocks are like the VIP section of the chart: exclusive, precise, and only for the cool kids, aka smart money. So while retail traders are fumbling with massive supply zones, ICT traders are sniping specific candles like pros. Now let's talk about the market maker buy-sell model in Wyckoff. First of all, shout out to Wyckoff. The man was mapping out accumulation and distribution schematics before most of us even knew what candlesticks were. His theory is like the OG guide to how markets move. But here's the kicker: Wyckoff focuses a lot on the structure of these moves, like springs and upthrusts, which are basically fakeouts to trap traders. ICT takes this and says, okay, but why do those fakeouts happen? Oh right, liquidity. With the market maker model, it's all about liquidity manipulation. ICT shows you the real engine behind those moves: smart money hunting stops and sweeping liquidity before driving price. So Wyckoff gives you the roadmap, but ICT hands you the keys and tells you why you're taking that specific route. All right, let's dive into optimal trade entry, OTE, versus the good old Fibonacci retracement. Now, retail traders love Fibonacci like it's their favorite indicator. And why not? It's easy. Draw it from a swing high to a swing low, slap on the 61.8% level, and call it a day. Boom, you're a pro. But here's the problem. Fibonacci by itself is like a GPS that doesn't know about traffic. Sure, it shows you a path, but does it consider what's actually happening in the market? Nah, ICT's OTE, on the other hand, is like GPS with live traffic updates. It still uses Fibonacci, but it doesn't just throw it on any random swing high or low. ICT says, wait a minute, has price already swept liquidity? Has it reacted to an order block? If not, that fib level is basically a trap. So yeah, both use the same golden zone, but OTE is like fib with a PhD. It's a little more selective and a lot more context-driven. Now for the fun one: liquidity pools versus double tops, bottoms, and trend lines. Here's where retail trading gets absolutely dunked on. Retail traders look at double tops and bottoms like they're the market's unbreakable fortress. Oh look, a double top. Price is definitely reversing here. Spoiler alert, it's not. Double tops, bottoms, and trend lines are basically bright neon signs for liquidity. ICT traders see them and think that's where all the retail stop losses are chilling. Let's take them out. It's like a game of hide and seek, except retail traders are hiding in plain sight. And smart money's like, we see you. Thanks for the free money. So while retail traders are setting their entries at double tops or placing stops below trend lines, ICT traders are waiting for the liquidity sweep before making their move. Now here's the big question: are ICT concepts plagiarized or improved? Let's call a spade a spade. There's definitely overlap between ICT concepts and traditional retail strategies. I mean, supply and demand, Wyckoff, Fibonacci, they're all in there. But ICT doesn't just copy these ideas, it flips them on their head. For example, instead of seeing double tops as strong resistance, ICT sees liquidity. Instead of using Fibonacci blindly, it layers it with institutional logic. And let's not forget the infamous order blocks. Sure, they look a lot like supply and demand zones, but ICT's focus on precision and mitigation adds a whole new layer. So, is ICT plagiarized? Maybe. But does it make you look at the market differently? Absolutely. And that's the real question. Does it work? Because at the end of the day, it's not about who came up with the idea. It's about who's actually making money with it. The truth is, trading is all about finding what works for you. So what do you think? Are ICT concepts a legitimate evolution, or just retail strategies with a fancy label? Drop your thoughts in the comments. I'd love to hear your take. Oh, and before you go, don't forget to smash that like button, subscribe, and hit the bell icon for more no-nonsense trading insights. Until next time, trade smart, stay sharp, and stop falling for double tops.